The room is cold before the day has fully begun. Not dramatic, not chaotic, just cold. Screens glow against the dark glass. Numbers move quietly across them. Some shift by fractions. Some move fast enough that your eyes lose their place. A coffee sits near your hand, but you have already stopped noticing it because something larger than the room has taken your attention. You are close to money in motion. But close does not mean trusted. Not yet. From the outside, Wall Street trading looks like a contest of prediction. People imagine the winner is the person who knows where the market goes next. Up or down, buy or sell, fast enough, smart enough, certain enough. But inside the system, prediction is only the surface. The deeper question is not whether you have an opinion. Everyone has an opinion. The real question is whether the system will allow capital to pass through your judgment. At every level, the change is not only salary, title, or status. It is permission. Permission to see more, to touch more, to risk more, to be wrong without destroying trust, and eventually to decide where capital is allowed to move. This is the hidden structure of a Wall Street trader, not a ladder of confidence, a ladder of controlled risk. Level 1. The Screen Watcher. At the first level, you are not really trading. You are watching. You sit close enough to hear decisions being made, but far enough away to know none of them belong to you. Prices change. Messages move. People react quickly, sometimes without explaining what they have seen. Your job is not to be brilliant. Your job is to absorb. You learn which numbers matter and which ones are noise. You learn that a calm voice can carry more pressure than a loud one. You learn that every change on a screen is attached to someone's exposure, someone's limit, someone's earlier decision. This is the first quiet shock. The numbers are not just numbers. They are responsibility. And you do not have responsibility yet. You have proximity. For a moment, that feels powerful. Then you realize proximity is not power. You are near the machine, but you are not part of its control system. You are allowed to observe the language, the rhythm, the restraint, the pause before a decision. The hidden cost is silence. You cannot reveal every gap in your understanding. You cannot interrupt every sentence. You cannot turn confusion into noise. So you watch carefully, speak less, and learn that the first test is not intelligence. The first test is whether you can stand near pressure without adding to it. And if you can do that, the system gives you something small. Not authority, contact. Level 2. The Controlled Hand. At the second level, you are allowed to touch the process. Only a little. A small instruction, a limited action, a task with boundaries around it. From above, it looks minor. From your side of the screen, it feels enormous because your hand is now connected to something real. This is where risk becomes physical. Not theoretical, not something you study later, not a clean chart after the damage is already done. Now a mistake can travel. It can move from your screen into the desk, from the desk into a report, from a report into someone else's question. The size is controlled because the system is not giving you freedom. It is testing whether you can operate inside a frame. A small loss can be accepted. A careless loss cannot. That difference matters. Wall Street does not remove trust simply because you were wrong once. Being wrong is part of the business. Trust disappears when your mistake proves you do not understand limits. At this level, you are not afraid of becoming poor. You are afraid of being pulled back. You are afraid the door that opened slightly will close again. You are afraid someone will decide the system is safer without your hand near it. So you learn restraint. You learn that speed is not the same as control. Confidence is not the same as permission. And every small action is really asking the same question. Can capital survive contact with you? If the answer becomes yes, the system offers the next danger. Risk under your own name. Level 3. The risk-bound trader. Now the risk has your name on it, not as a symbol, not as practice. A small book exists inside the system, and part of it belongs to your judgment. The limits are narrow. The capital is controlled. But the distance between your decision and the result has disappeared. The P&L is no longer something you help record. It is something that follows you. Each day begins with a quiet question before any trade is placed. Can you keep the right to continue? Can you make decisions without letting one wrong move become something larger? Can you lose in a way that still makes the system trust you tomorrow? Profit gives you confidence. Loss gives you information. And sometimes the information is heavier than the money. A few bad choices can erase several good days. A position that looked reasonable in the morning can become a test of discipline by afternoon. This is where risk control becomes real. It is not there because the firm expects perfection. It is there because the firm expects you to be wrong and still remain usable. You are not being paid to always know. You are being tested to see whether you can be wrong without damaging the structure around you. And if you survive that test long enough, the limits begin to widen. But with larger limits comes a different problem. The market begins to notice your size. Level 4. The liquidity reader. At this level, trading stops being only about direction. The question is no longer just whether something should rise or fall. The question is whether you can enter, hold, and leave without turning your own trade into the problem. This is where liquidity becomes real. Liquidity is not just activity on a screen. It is the ability to move capital in and out without forcing the market to move against you. At a small size, you can pass through quietly. At a larger size, your presence leaves marks. You begin watching depth, crowding, panic, and exits. You notice where other people may need to sell, where buyers disappear, and where a good idea becomes dangerous because too much capital is trying to pass through the same narrow door. A trade can be right in theory and still fail in practice. The direction can be correct, but the size too large. The entry can work, but the exit can vanish. The opportunity can be real, but too fragile for the capital placed behind it. This is the next layer of the machine. Skill is not only seeing opportunity. Skill is knowing how much capital that opportunity can survive. And once the size grows again, the risk no longer stays inside one position. It begins to touch the reputation of the entire desk. Level 5. The Desk Risk Keeper. At this level, the risk no longer belongs only to you. You still make decisions. You still understand the pressure of a position moving against you. But your real role begins to change. You are no longer just searching for opportunity. You are protecting the shape of risk around the desk. Junior traders look to you before they fully understand what they are asking. Risk managers watch numbers that now connect back to your judgment. Reports move upward, and the desk's reputation is no longer abstract. It is something your decisions can strengthen or weaken. This is a different kind of pressure. You cannot show panic just because the market becomes unstable. You cannot become reckless because one part of the desk is doing well. You cannot let confidence in one idea spread into a risk profile that no longer makes sense. From the outside, you may look calm. Inside, you are asking what could break if the market turns. Which position is too crowded? Which trader has too much conviction? Which loss is still acceptable? And which one is beginning to threaten the structure? This level does not reward the person who wins big once. It rewards the person who keeps the desk alive through conditions that tempt other people to overreach. And when the desk believes capital is safer under your judgment, you move into something more dangerous than trading: allocation. Level 6. The Capital Gatekeeper. Now you are not only using capital, you are deciding who receives it. This is where power becomes quieter. It is no longer expressed through one trade, one call, or one strong opinion. It appears in the decision to increase one trader's size, reduce another trader's limit, support one strategy, pause another, or hold capital back until the conditions are cleaner. At lower levels, you try to prove that your decisions can make money. At this level, you decide which decisions deserve money behind them. That is a different form of authority. Because capital does not flow naturally. It moves through trust, rules, incentives, and limits. Someone is always deciding what deserves more room and what must be contained. The hidden cost is that simplicity disappears. You are no longer judged by a beautiful trade. You are judged by whether the whole structure survives across different markets, different shocks, and different forms of pressure. More power means more consequences. Every allocation creates a signal. Someone is expanded. Someone is restricted. Some risk is accepted. Some risk is quietly removed before it becomes visible. And when capital begins to come from larger institutions, the question changes again. Not whether you are smart, whether your system can be trusted through cycles. Level 7. The Institutional Operator. At this level, the money no longer feels like money from one desk. It arrives from institutions, pension funds, endowments, foundations. Allocators with obligations that extend far beyond one quarter, one trade, or one impressive year. Their capital does not come to be entertained. It comes looking for endurance. This changes the game. You are no longer judged only by whether you can produce returns. You are judged by whether those returns can be explained, whether the losses can be defended, whether the process can be repeated when the market is calm, and still understood when the market becomes hostile. A small loss is not always failure. Sometimes it is simply the cost of staying in the game. But an uncontrolled loss says something deeper. It suggests the system did not understand its own exposure. It suggests the structure was depending on confidence where it should have had discipline. That is what institutional capital fears, not volatility by itself, but the discovery that the person holding the risk does not fully understand the risk. The hidden cost is that being right is no longer enough. You must be right in a way that can be audited, explained, repeated, and defended in front of people who are not impressed by speed, charisma, or market stories. They want to know what happens when your best idea stops working. They want to know who cuts the risk. They want to know whether the system survives after the trader is no longer excited. At this level, you are not selling brilliance. You are selling the belief that capital can pass through your structure without being turned into a gamble. And when the capital becomes large enough, even moving it becomes a problem. Trading is no longer a single act. It becomes architecture. Level 8. The Market Architect. At the highest level, you are no longer living inside every price movement. Smaller movements still matter, but they are no longer where your attention lives. Teams below you handle execution, monitoring, analysis, reporting, and adjustment. Other people watch the screens. Other people carry the immediate pressure. Your work sits above the motion. You decide which exposures are allowed to exist, which risks must be hedged before they become visible, which strategies receive more oxygen, which ones are slowly reduced, which areas of the market can absorb capital, and which areas are too narrow to touch without revealing your hand. This is where power becomes indirect. You do not need to be the fastest person in the room. You need to understand how the room is connected to the rest of the system. At lower levels, you saw prices. Then you saw risk. Then liquidity. Then trust. Now you see structure. You see that capital does not simply enter the market. It travels through permissions, committees, limits, relationships, models, incentives, and fear. It moves carefully when visibility is dangerous. It moves slowly when size itself can change the outcome. The hidden cost is distance. You no longer feel the market the way you did at the beginning. You see it through reports, teams, systems, and second-order effects. Your influence is larger, but more isolated. You are not proving that you are a good trader anymore. You are proving that the architecture does not break when the market changes shape. And this is the final reversal. Final inversion/philosophical closing. The person at the top is not necessarily the one staring hardest at a chart. Not the loudest, not the fastest, not the one with the strongest opinion. The person at the top is the one the system trusts to decide which risks are allowed to exist, which capital receives more room, which people are restricted, and which flows must move quietly enough that the market does not fully see them coming. At the bottom, trading looks like making money. At the top, it becomes something colder, a position inside the system that decides where money is allowed to go.